In today's session, we're going to take a look at some of the complications that we have working with real-world data. Using some of the textbook examples is often very simple and very predictable, as it should be for a textbook, but when we start to deal with real-world situations, we find that organizations will choose to do calculations in a certain way. And then when you move from one to another, they do things differently. This is by design, and quite often a lot of thought has gone into how certain information is presented. Today we're going to take a look at some of the differences in opinion that you'll find between each of these different ways. But before we do that, I want to start off by taking a look at some of the expectations that come with this course. When we're talking about the level of difficulty, the level of involvement that we have with the information, we of course take into account that people do this course for many different reasons. Some people plan to have a career in finance and intend to get into things in a very involved way. Other folks will be doing this course because it's part of a bigger program like the MBA, and they only want enough to get through the program, and that's fair. When we think about the depth, starting from the bottom of this inverted triangle, we can see that some of the most basic and fundamental things that we study include things like the days ratios, the cash conversion cycle, and basic interpretation of working capital when we're talking about the working capital ratios. Of course, this is a very superficial view that doesn't take into account all of the things that happen in working capital in an organization, like cash management, the details of different stages in inventory management, and the interpretation of that data. Also, some of the important trade-offs between the cost of not having goods to sell and the cost of carrying all of that inventory. So we think of those as the key concepts. Drilling down a little bit even further, or in this case drilling up a little bit further, we would say that all of this can be embedded into other important topics in working capital management, including things like systems management, electronic data interchange, different instruments like letters of credit, factoring, invoice discounting, cash floats, and so on. This can become very complicated as we start to talk about things like the use of AI in inventory management and logistics in general. The applications are a much more detailed view of the fundamentals of the key concepts. For this course, general expectation is that you need to know about the fundamentals. So in order to pass this course, you need to be able to produce the days ratios, to be able to provide some basic interpretation, to understand how a cash conversion cycle works. Also, some of those key concepts are going to be part of what you need in order to pass. But anybody who wants to be effective using this type of financial information needs to have a good grasp of key concepts, and also has to have a passing interest at least in some of those applications. Now, of course, substantial expertise in this particular area means that you know all about the applications, and you know a little bit about the applications yet to come. But that was just the preamble. Today's session, we're going to talk much more specifically about some of the problems with doing ratios and why ratios might look a little bit different from one source to another. When we calculate financial ratios, there's always a simple version. For example, if we're talking about the return on equity, the whole ratio is right there in the title, return on equity. So we could say, well, we need a measure of return, like net income. And the equity that we're going to divide that by is typically the book value of the total equity. And that means that we're looking at things like the shares outstanding, the retained profits, and any adjustments that we've had to that. Pretty simple stuff. However, we can actually do those kind of ratios in a more complicated way. And when reporting agencies like Standard & Poor's and Bloomberg, Refinitiv produce those ratios, they may make adjustments. Sometimes they will self-report how they've calculated those ratios, sometimes not. And so you can see that the same ratio for the same company for the same year might actually be presented a little bit differently. When we're talking about the different measures to use in the numerator there, we've already got a number of different possibilities for what we mean as return. Depending on where you sit in the organization, return may look very differently. And as an analyst, we only hold the reporting entity responsible for the things they control. So if you're looking at the total organization from an outsider's perspective, we might just use net income. Net income itself can be a little bit complicated because some organizations do things like remove excise tax. So the excise tax might be reduced from the total revenue to get net income. So we already have two different numbers there before we even start. If you're a manager within the company, you don't get to make decisions quite often about things like whether we borrow or fund with equity the investments that we make. So should we hold managers responsible for things they don't control? Clearly not. So that means we probably aren't going to use things like interest in our calculation, and we're probably not going to include taxes because decisions about where to produce you're usually taken at a much more senior level, probably at a board level. So we want to use an operating profit to assess operations, and that's why we use EBIT. Perhaps our managers are not able to make decisions about whether they rent or buy certain equipment. Do we use our warehouse or do we contract? In that case, things like depreciation and amortization may standardize that information. It also allows us to compare different companies that operate in a different way without causing a penalty for things like depreciation and amortization. So maybe in the numerator of that equation, we're going to use EBITDA. If you're looking specifically at a plant manager, the plant manager doesn't control a lot of the fixed overheads. And so that's why we're more likely to use the gross profit in calculations of performance. So already, before we even start, if we're talking about things like the profit margin, or if we're talking about the rate of return on assets or the return on equity, in the numerator we can have 4 or 5 different versions of what profit means. And that's significant. It's mostly important that you're consistent. If you're comparing a company across time, or if you're comparing 2 different companies or 4 different companies, we want to make sure we use the same type of calculation for all of them so that our results are not method dependent. A little bit more on that later. A couple of interesting examples of how we might use different information include things from the balance sheet like debt and equity. Some companies may only report, especially in their non-GAAP statement, things like net debt. Net debt is a way of reducing the amount of debt that you report by taking something like the long-term debt and subtracting cash from that. The logic is that we could repay that debt today if we just use some of our cash, so we're really not as highly leveraged as it looks. However, we often see that companies will already have plans for that cash, and by the time we read the accounts, that cash may no longer be on the books. One company that we worked with had actually already used the cash that they reported in their previous accounts to do an acquisition, so it was not available to repay the debt. So gross debt is something that we're much more likely to use, even though the companies might do things differently. And in some cases, you have to dig a little deeper into the accounts to find that statistic. Another strange thing that we sometimes see is companies that are worth less than nothing. They have negative book value of equity. Their retained earnings have actually been reduced below 0, often for reasons like doing acquisitions and writing off goodwill at the time of an acquisition, something you possibly remember from your accounting classes. We can see, for example, McDonald's has got negative book value of its equity. That doesn't mean McDonald's is worth less than nothing. In fact, if you take a look at the company's share, a better number to use in situations like that is the market value of the equity. It's the share price reported today times the number of shares outstanding. We can see the market cap number is reported as one of the headline numbers in most of the online sources. So a good question, do you use book value or do you use market value? If you've decided to use market value, that's, I think, a good thing generally, but make sure you use it for all of the companies or all of the years for which you're doing the analysis. Don't mix book value and market value statistics. When we're looking at working capital ratios, another great example that we have for days ratios. Do we use the sales number? Remember, days ratios are typically something like inventory divided by sales divided by 365. Well, we don't actually buy our inventory at the selling price. We buy it at the cost of goods price. So in many cases, you'll see that more complicated versions of this will use things like the cost of goods sold, or sometimes cost of service if that information is available, or cost of sales. And we might also use credit sales rather than total sales for the accounts receivable period or the days sales outstanding. A couple of other interesting complications. There is an advantage to using sales across the board for thing to look for. The problem that we have is that inherently accounting information is prepared using two different and very, very substantially different types of information. We've got the income statement and the cash flow statement information, and one of the central words to each of those terms is flow. This is the flow of the income, or the flow of cash through the company over the 365 days of the reporting year. Information from the balance sheet and from the statement of changes is reported as at a particular amount at a particular point in time. So we're taking stock. That's a stock number. We're taking stock at a particular point in time, on a particular day. So December 31st, 2023, that was the day that we measured the amount of inventory that we have, the amount of accounts receivable, the amount of debt. But the income that relates to that was earned over a full year. And that can be a little bit misleading. We see things like addition of fixed assets during the year. So we started the year with $1 million in factory, and by the end of the year we had 2 because we decided to buy a second factory. We didn't have that facility available for the whole 365 days of the year, so we may be underreporting our performance because we did not have a $2 million asset against which we charged that income. So we have a problem, an inherent problem, anytime we have a ratio that mixes a stock and a flow. If we think about this according to the line above, if we go from January to January, our calendar year is January 31st, and we have 2 bits of information that are reported at the end of the year from the balance sheet, but from our income statement, we may be having huge sales in January and it falls off during the year, and at the end of the year the sales have gone way down. The number that we report for the year, regardless of when we earn it in our annual report, is the average, this dotted line. So we say January 2023, our sales level was this amount here, regardless of the fact that the monthly sales had fallen off to next to nothing. That is a flow statement item, and we're comparing that to things like our inventory. Inventory gets measured on one day at the beginning of the period and one day at the end of the period. And our inventory can be very different based on that very different information. So that's the nature, that's the problem with this particular issue. And here's an example of how we might be able to work with this. We've got some basic information for our hypothetical company. We've got sales that last year were 2 million, this year were 1.5 million. So already we see sales have dropped off. Inventory has mostly stayed the same. It dropped by a little bit. We measured the inventory at the beginning and the end of the period, but our sales for 2023 are only this $1.5 million. If we calculate the day's inventory which I've done for you here. Essentially, that's just taken as textbook version, inventory divided by sales divided by 365. Or according to some people, let's say inventory divided by cost of goods sold divided by 365. 2 million in sales for the first year of inventory on the shelf. Not an unusual number. If we calculate that for the next year, we had 190,000 in inventory over 1.5 million in sales divided by 365. So we see a substantial increase in our days ratios. They've gone up by 10 days. That makes sense because we have just about as much inventory, but only about 75% as much in sales. Now, this may actually understate how bad things are. If we calculate things a little bit differently, using average inventory instead of the periodic inventory, here we're taking something like inventory at the beginning plus inventory at the end divided by 2. So that's our average inventory. Again, divided by sales divided by 365. Our calculation then is 200,000 plus 190,000 divided by 2. That gives us 195,000. Divided by the end of period sales, the year's sales, 1.5 million, divided by 365. Our result is actually a little bit worse than the one that we reported the other way. It says our inventory has increased by more like 11.5 days. And that's a serious problem if we're talking about a company with hundreds of thousands in inventory. That's an awful lot more inventory that we have to finance. So we can do this using the beginning and end of period. We can even do this on a quarterly basis. So we could take the first, second, third, fourth quarter numbers for inventory, divide that by 4, and that will help us to get an even more useful number. And if we're inside the company, we can do it on a monthly basis. We've got all of the data for each of the monthly inventory levels. And if you're the company's banker, perhaps you're even asking for that kind of information, especially if you're worried about that account. That's already an awful lot. A couple of other things I wanted to talk about today. How do we deal with missing data? There are a number of reasons why we might have missing data. Often you can't calculate information for a company because your number is actually 0. If you're talking about a company with 0 net income, 0 equity, or negative equity, as you have a denominator, in that case the equity goes to 0, the ratio goes to infinity. And that just doesn't make any sense. And also if we end up with a negative for our return on equity because our equity was negative, that doesn't make sense either. In fact, if we had a negative profit and a negative equity, we'd end up with a positive number, which also wouldn't make sense. So you have to check those numbers and make sure that they still make sense to you. Saying I calculated the ratio and that's what the number is, I don't know why, but it's just not enough. You have to be able to explain what the problems with those numbers are. So 2 things to remember. If the denominator goes to 0, we have a problem. The value goes to infinity. That's a nonsense number and you can't use it. If the numerator is 0 or negative, you can still use it. For example, you can still have a negative rate of return on assets or a negative return on equity if the net income or the EBIT is negative. That's another reason why we sometimes use EBIT or EBITDA, because companies that often have negative net income will have positive EBIT or EBITDA because of the cost of financing or the amount of taxes that are not part of operations, therefore not so meaningful, have screwed up our number. If you're using a set of peer companies and you're taking the average of 4 or 5 companies to compare to your company, it's not a big deal to drop one of those numbers or even a couple of those numbers. Make a note of it. You don't want to make changes to the data with no reason. That's just called manipulating data. So we want to make sure that you make a note if you decided to drop one of the peer companies in the calculation and use an average of 4 instead of an average of 5. That's entirely allowable. If you're missing a number for the main company, then often we just say that the result is not material. If you end up with a rate of return on equity approaching infinity because you have $1 million in net income and you have $1 in total equity, then that number we just say is not material. It's a silly number. And that would be true if one of our peer companies was in that position. If we end up with a number that is just ridiculously large, use the average of 4 out of 5. Before you give up on certain information, remember that companies have the option, if they believe that the information is not material, to put some of that information in the notes. So for some companies, numbers like accounts receivable or inventory might have been moved to the notes to the accounts because they're just not large enough against the total value of the company's balance sheet to include in the accounts, but it may still be interesting for us as part of our exercise. I've used the word material. Material is all about judgment. If we are looking at certain types of companies, we are missing data because it's considered to be not material, at least for the purposes of reporting. Companies, some service companies, might not have any inventory because their inventory is not considered to be a material part of their business. But of course, everybody's got some inventory. If you're an advertising company, J. Walter Thompson, and you have rented buildings and you've the product that you produce really isn't dependent on physical assets, you've still got some inventory. It might actually be something really strange like work in progress. Can use that. If your company isn't publicly traded, you can't calculate something like a price-earnings ratio because the share price is not quoted. And we don't have a meaningful price, so we don't have a meaningful price-earnings ratio. Again, if you've decided to use a private company as part of your peer comparisons, then you won't be able to use their price-earnings multiple. And in any case, you probably shouldn't compare price-earnings ratios across companies that are in very different businesses. So don't worry about it. Don't sweat the small stuff, I guess people would say. If you have a dollar or $1 million discrepancy for a billion or $1 trillion company, then that missing information is considered to be not material. It doesn't make a difference in the decision that we ultimately make to invest or not. By now you've probably discovered something that is a real truism in any kind of endeavor, that work expands to fill available time. You'll always find yourself with enough busy work. Don't go making extra busy work just for the hell of it. You have to decide how far you're going to go in your analysis. In some cases, I've been very impressed to see people make a really good choice to use information like segmental information. That's information about different operating divisions or different geographic locations. You'll find this either in the notes to the accounts, and sometimes it's in the management discussion. If we see there's a change in the trend, that might be something meaningful. For example, if you're looking at a telecommunications company and you see something like the demand for the sales of mobile telecommunications is increasing at a very high rate, but the company has also added businesses like media, which is also growing fast, and it has some legacy business like landlines that are actually shrinking. Looking at some of the numbers for those individual operating activities can be very insightful. You might decide that's worth spending a few words talking about how the company's overall performance has changed because the high margin mobile telecommunications business is growing more slowly than the lower margin media business. That's very insightful, and it's worth doing that kind of work. You might also find that for some businesses with a lot of inventory, there is information about different types of inventory. Raw materials, strategic inventories, work in progress, finished goods inventory. And at a different point in the operating cycle, we might see a different mix in the type of inventories that we have. So finding that information in the notes to the accounts might be very meaningful. Obviously, if your company doesn't do a lot with inventory, probably isn't going to be a big deal. If you're using 5 companies for your peer comparison, probably it's not worth talking about each of the 5 individually, unless one of the companies is a strange outlier and you might use that as an explanation why the average has moved. So take the average of the 5 companies and compare your company to the average of the 5 companies over 5 years. Don't compare your company to each of the 5 individually. You'll end up writing a book rather than just a paper. I hope that this has been helpful and interesting. There are a lot of things that we talk about in our sessions in class that often come from questions. Some of these points have been highlighted from the questions that I've read in our discussion forum. So keep those questions coming. If you do have a problem or an issue, put that out there in the discussion forum, and I'll do my best to keep up with that. But for today, that's all I really wanted to talk about. So until I see you in class, goodbye for now.